Welcome to Finance Deep Dive.
So in this video, we're diving right into a massive question.
I mean, you've heard of people or even big companies going bankrupt, right? But what about an entire country? Can that actually happen?
Well, the short and maybe pretty surprising answer is yeah. Yes, it can.
Okay, so in the world of big-time finance, they have a name for this, a sovereign debt crisis. Basically, it's what happens when a country defaults, which just means, it literally can't pay back the money it owes.
But that kind of brings up another question, right? Why would a government get itself into that mess in the first place?
Well, it turns out borrowing isn't just common, it's pretty much essential to how a modern country even works.
See, governments are borrowing money all the time to fund the really big stuff, the building blocks of a society. We're talking about huge projects like infrastructure, healthcare, national defense, you name it. Things that the taxes we pay just can't cover all at once.
Okay, so if borrowing is totally normal, what's the tipping point? When does it go from being manageable to, well, a full-blown crisis?
Well, a big red flag is when a country starts borrowing way too much. We're talking debt that's growing a whole lot faster than its actual economy.
Then you've got high interest rates. A sudden spike in those can be like throwing gasoline on a fire. All of a sudden, just paying the interest on that debt becomes way more expensive.
And then there are currency problems. If a country's own money becomes weaker, any debt they owe in, say, US dollars suddenly gets a lot harder to pay back.
And of course, a weak economy just makes everything worse. Tax money dries up, and the government has even less cash to pay its bills.
And listen, this isn't just some textbook theory. This stuff happens in the real world, and the results can be absolutely devastating.
Just think about Greece back in the early 2010s.
They ended up needing a huge and super controversial bailout from the European Union and the IMF just to keep from going completely under. Or how about Argentina? Man, they have a really painful history with this stuff. They've defaulted over and over, basically telling the world, sorry, we're not paying you back those billions of dollars.
And a more recent example? Take a look at Sri Lanka.
Their whole economy was just crippled because they literally ran out of foreign dollars to pay for essential things, like fuel and medicine. So when a country defaults, it sets off this awful chain reaction. First thing, investors flee. The money just vanishes from the country almost overnight. And when that money leaves, the country's currency just crashes. It goes into a total freefall. With a crashed currency, trying to buy anything from other countries becomes insanely expensive. And that means inflation just soars. And here's the bottom line. For regular people, the price of food, of fuel, of everything, it becomes unbearable. Just getting through the day becomes a struggle. So after all that, what's the one key takeaway here? The final bill, so to speak. Well, here's the crucial difference. You or I, we can declare bankruptcy. But a country doesn't just disappear. The nation keeps going. And the real cost, the final bill, it falls on the people. It's always the citizens who have to pay the true, painful price for all of it.
If you like the content, don't forget to subscribe. It motivates us to keep posting.